Yeah, this is day 7 of the series, and we'll be continuing on the problem sets for the first chapter. And from the sixth question, I think. We only have half an hour, so we'll need to do this a little bit quickly, as much as I can cover. So, yeah. Sixth question is, suppose housing prices across the world double. Part A, is society any richer for change? Part B, are homeowners wealthier? Part C, can you reconcile your answers to A and B? Is anyone worse off as a result of the change? Society doesn't become richer or gain any real value just because housing prices double. It's largely a nominal change which increases, a nominal increase which can distort economic well-being of the world by causing unnecessary change in wealth distribution, since there's no wealth creation and there's no increase in the quality in housing, but only affordability of housing, and therefore creates inflation. Homeowners feel wealthier since they now own this asset which has doubled in price, and definitely selling their home at that point would be really advisable, as they can cash in and make that increase in price feel real. However, this does not indicate wealth creation, as there is only wealth redistribution from one person deciding to spend 1 crore in home and 1 crore in other expenses to spending 2 crore in home instead. So yes, homeowners are wealthier, but it's not a real gain unless they choose to sell, which most people would in the situation if they knew that they couldn't get a better price. Part C is, yes, the people purchasing the homes at the double prices are 100% worse off, since they're buying the home at an extremely inflated rate, and eventually when others realize that it is way overpriced, the value will fall through the roof and they will be left with an enormous loss on a real estate investment just because they thought it would go higher. So that's question 6. Question 7 is, this is an example of a company called Shivam Software. Is a startup computer software development company. It currently owns computer equipment worth 1.5 million rupees and has a cash on hand of rupees 200,000, contributed by Shivam's owners. For each of the following transactions, identify real and/or financial assets that trade hands. Are any financial assets created or destroyed in the transaction? Shivam takes out a bank loan. It receives 2.5 million in cash and signs a note promising to pay back the loan in 3 years. So for each of the following transactions, identify real or financial assets. Okay, so you need to identify real and financial assets that trade hands, and also any financial assets created or destroyed in the process. So the first part A is Shivam takes out a bank loan. So that's a creation of a financial asset. Receives 2.5 million in cash and signs a note promising to pay back the loan in 3 years. So financial asset traded. The bank provides Shivam with a loan of 2.5 million rupees in cash, financial asset for Shivam. In return, Shivam issues a promissory note, a financial liability for Shivam, and a financial asset for the bank. Creation of financial assets, yes, a new financial asset is created, the promissory note representing the loan agreement. So that's part A. Part B is Shivam uses the cash from the bank plus rupees 50,000 of its own funds to finance the development of new financial planning software. So for this, Shivam uses cash for software development. So in this, real asset is created. The funds are used to develop new financial planning software, which is a real asset, intellectual property for Shivam. Financial assets used, cash from the bank loan and rupees 50,000 of Shivam's own funds are used, which reduces Shivam's financial assets. Creation slash destruction of financial assets. No financial assets are created or destroyed, as cash is simply converted into a real asset. Part C is Shivam sells the software product to Infosys, which will market it to the public under the Infosys name. Shivam accepts payment in the form of 10,000 shares of Infosys stock. So, real asset traded. Shivam sells the developed software to Infosys. So, that's the real asset which is given to Infosys by Shivam. And then financial asset received is 10,000 shares of Infosys stock. So that is the financial asset which is received by Shivam. Then creation and destruction of financial assets. No financial assets are created or destroyed, as Shivam is exchanging a real asset for an existing financial asset, Infosys shares. Part D is Shivam sells the shares of Infosys for rupees 2,000 per share and uses the part of the proceeds to pay off the bank loan. So Shivam sells Infosys shares and pays off the bank loan. So financial assets traded are the 10,000 Infosys shares traded for 2,000 each, generating 20 million in cash rupees. And financial assets used part of this cash used to pay off the 2.5 million bank loan, eliminating Shivam's liability, financial asset of the bank. The bank loan, financial asset for Shivam, is destroyed as Shivam repays the loan. So that was question 7. Question 8 is consider Shivam software for problem 7. So same company. Prepare its balance sheet just after it gets the bank loan. What is the ratio of real assets to total assets? Prepare the balance sheet after Shivam spends 2.55 million rupees to develop the software product. Part C, prepare the balance sheet after Shivam accepts the payment of shares from Infosys. What is the ratio of real assets to total assets? So we have to create a balance sheet. So I'm not going to create the balance sheet written because I don't have the time right now. But I've created it in the Google Docs in front of me. It's not visible on screen, but like I'll just go through it one time. So assets under real assets, computer equipment 1.5 million, financial assets cash 2.7 million, total assets 4.2 million, and liabilities and owner's equity, bank loan 2.5 million, owner's equity 1.7 million, total liabilities and equity 4.2 million. Ratio of real assets to total assets. So real assets are the computer equipment, and total assets is 4.2 million. So that'll be 1.5 by 4.2 or 35.7%. Part B, balance sheet after spending 2.55 million rupees on software development. So software product will come under real assets, and 2.55 million will be subtracted from the cash. So the total assets and total liability will still be the same. Balance sheet after receiving Infosys shares as payment. So now we've sold the software product. So real assets only comprise of the computer equipment, which is at 1.5 million rupees. Under financial assets, we have cash plus the Infosys shares. Yeah. So the ratio of real assets is still the same at 35.7%. Question 9 is examine the balance sheet of commercial banks in table 1.3. What is the ratio of real assets to total assets? What is the ratio of real assets to total assets for non-financial firms, table 1.4? Why should this difference be expected? So table 1.3, I don't know where table 1.3 is actually. This is one second, if I can find it. Yeah. uh hmm. Yeah, table 1.3 is this. So we need to find the ratio of real assets to total assets in 1.3. So I don't know if this is visible, but the total real assets are coming as $125.2 billion, and the total assets is coming as $14,893.4 billion. So let me just edit this in the document. I have not done question number 9 here. So in question number 9, table 1.3, yeah, so table 1.3 part, so part A, ratio of real assets to total assets. So real assets by total assets equals so for this one, real assets is 125.2 billion divided by 14,893.4, which will be equal to 0.008. So yeah, 125.2 by 14.3.4. So around 0.8%. So that's the ratio for that. And then for non-financial firms, which is table 1.4, this one, real assets is 21,417. So 1 second. Real assets is equal to 21,417 billion by total assets is 39,501. So that is that. Okay, so as we can clearly see, in the financial firms, the real to total asset ratio was very, very low. It's at 0.008. But in non-financial firms, the ratio is pretty evenly distributed between real and financial assets at 0.542. So real by total assets in non-financial firms is coming as 0.542. So in part C, we have to answer why this difference should be expected. So I think this difference should be expected because in financial firms, the ratio between financial assets and real assets is immense compared to that of non-financial firms. This is because, this is because in financial firms, real assets are not required as much as they are in non-financial firms, since they are not dependent on them to make profit. Whereas in non-financial firms, most of the profit revenue comes from real assets and the goods and services that they produce. So that's that answer done. So that's question 9 done. Now we move to question number 10. We have 10 more minutes. So question number 10 is consider figure 1a, which is given here. It's very unreadable because it's very small. Which describes an issue of American gold certificates. Is this issue a primary or secondary market transaction? B. Are the certificates primitive or derivative assets? C. What market niche is filled by this offering? So, okay. So we have been given an American gold certificate here, which is worth $100 million. A lot of money. And yeah, so is this issue a primary or a secondary market transaction? So American gold certificates would typically be a secondary market issue. These certificates represent a claim to the gold held by a financial institution and would likely be bought and sold among investors after the initial issuance. If they are newly issued, the first sale would occur in the primary market, but after that, they would trade in the secondary market. Are the certificates primitive or derivative assets? Gold certificates are considered primitive assets because they represent a direct claim on a specific asset, gold, rather than deriving their value from another financial asset or index. Derivative assets, by contrast, are typically based on the price movements of other assets like options or future contracts. What market niche is filled by this offering? Gold certificates fill the niche for investors who want exposure to gold without physically holding or storing the metal. They offer a convenient and secure way to invest in gold, providing a claim to the commodity's value without the logistical challenges of ownership. This appealed to those interested in hedging against inflation or currency fluctuations while maintaining liquidity. Question number 11. Question number 11 is discuss the advantages and disadvantages of the following forms of managerial compensation in terms of mitigating agency problems, that is, potential conflicts of interest between managers and shareholders. A fixed salary. B, stock in the firm that must be held for 5 years. C, a salary linked to the firm's profits. So, answer number 11 is fixed salaries advantages. Advantages are predictability. A fixed salary provides a stable income for managers, allowing them to focus on long-term goals without having to worry about short-term performance metrics. Reduced risk of manipulation. Since salary isn't linked to profits or stock price, managers aren't incentivized to manipulate earnings or take excessive risks to boost their compensation. Disadvantages: limited motivation for performance. A fixed salary doesn't directly incentivize managers to work harder for a company's success, as their compensation isn't tied to the firm's performance. No direct alignment with shareholders' interest. Without a connection to stock price or profitability, a fixed salary can lead to managers prioritizing personal or departmental interest over maximizing shareholder value. Yeah, this is a big joke. Yeah, I saw a reel in which this dude was standing on like an edge on the edge of a hill, looking into the sunset and wondering, am I maximizing shareholder value? Because that's all life is about, right? I don't know. I just found that funny. Anyways, part B, we're talking about advantages and disadvantages of stock in the firm that must be held for 5 years. So advantages are alignment with shareholder interests. By holding stock, managers' wealth is tied to the company's long-term success, which aligns their interests with the shareholders. Focus on long-term value. The 5-year holding period discourages short-term profit-driven decisions and encourages sustainable long-term strategies that will benefit shareholders over time. Disadvantages: exposure to market volatility. Managers bear the risk of stock price volatility, which can be influenced by external factors beyond their control, potentially demotivating them. Reduced immediate cash flow. Since managers can't sell the stock for 5 years, it might be less attractive to some who prefer more liquid compensation. Salary linked to the firm's profits. Advantages: incentive to increase profits. A profit linked salary gives managers a direct motivation to improve the company's financial performance, aligning their goals with those of the shareholders. Encourages operational efficiency. Tying compensation to profitability encourages managers to cut unnecessary costs and improve productivity, which can increase shareholder returns. Disadvantages: short term focus. Managers might prioritize short term profits at the expense of long term investments, potentially harming the company's future prospects. Risk of manipulation. Managers may attempt to manipulate accounting figures or delay certain expenses to inflate profits in the short term, which could create misleading financial statements. Last question we'll do today is question 12. Oversight by large institutional investors or creditors is one mechanism to reduce agency problems. Why don't individual investors in the firm have the same incentive to keep an eye on management? Individual investors typically don't have the same incentive or ability to monitor management for several reasons. Smaller ownership stakes. Individual investors usually hold a much smaller percentage of the company's shares compared to large institutional investors. This smaller stake limits their influence on management and the financial returns they gain from active oversight. Limited resources and expertise. Institutional investors like pension funds or mutual funds often have dedicated teams and resources to analyze company performance, attend shareholder meetings, and engage with management. Individual investors lack these resources, making it hard for them to monitor or influence management effectively. Free rider problem. Individual investors may rely on the oversight provided by large institutional investors, assuming they will act on behalf of all the shareholders. This free rider effect reduces the incentive for individuals to engage in costly monitoring when they can benefit from actions taken by others. Cost benefit imbalance. For individual investors, the cost, time, and money of monitoring management closely often outweighs the potential benefits, especially when they hold diversified portfolios with relatively small positions in each company. Institutional investors, on the other hand, have more at stake and can justify the investment in oversight. Large institutional investors or creditors, given their substantial investments and influence, are therefore much better positioned and incentivized to actively monitor and influence management decisions. So that was question 12. We talked about why somebody like me or you or whoever who's investing in a company, maybe a few thousand or a few lakhs or whatever, might not be the best decision. And obviously, we don't have the ability to monitor and oversee the management of that particular company we invested in. A, because the number of shares we have is too little to influence anything and to have any sort of say in the company. B, it would be not efficient and economically viable for us to invest our time and money and resources into trying to oversee the management. compared to the amount of benefit we would get, since our share is so small compared to the institutional investors. So those are a few reasons why uh, um, uh, individual investors, that's the word, yeah, um, cannot and should not um, oversee the management and have a active say in what goes on in a company, since if a stock is big enough, millions of people can own it. So that is question number 12. That's where we ended today, and I'll do this again tomorrow. We'll continue from question number 13. Thanks.